Our monthly discussions about the Corion report have got a legion of fans that are growing more and more. And, after the last month, who better than guiding us through the insanity that seems to have grabbed hold of investment markets around the world than Corion's author of the report, co-founder of the company, David Bacher. David, I actually wanted to chat to you today about World Cup cricket, given your family's very strong cricketing background, but there's so much to go on the markets. Before we start on the markets, though, can we win? Can the Proteas win the World Cup?
I'd like to think so. I mean, we do have the players to go far. I would say we certainly aren't favourites for a reason. The perennial lack of all-rounders in the team, I think, could come back to haunt us. By no means probably the family expert in this matter, but from a personal view, I think probably our lack of depth in all-rounders in a game that has become very much dependent on going hard, going fast, scoring quick, and having depth at the end could be our Achilles heel.
Thanks for giving us that. I won't put any money. In fact, I don't bet at all anymore. I haven't done for many years. But if I was a betting man, after hearing that, All right, David. The markets in September were just like insane. Perhaps what we should do is let's get up some of the tables that will help us, certainly when we have a look at the viewing, to see a little better of about what's been going on with the markets in the past month. Just overall, though, while I start getting the tech ready. Overall, what is your big takeaway?
It was indeed a very tough month for investors as stock markets around the world slumped. Global equities ended down approximately 4%, and global bonds didn't do much better. So, it was difficult for most asset classes, and the primary culprits for these poor returns was no doubt the significant rising bond yields. Oil rose very quickly, and on top of that, you had a slew of global central bank meetings, which generally underline the prospects of higher interest rates for longer. So, against that backdrop, asset classes were under pressure.
Well, let's just look at those bond yields, and maybe you can give us a little bit more detail on that. In the United States, up by 0.5%. That doesn't sound much. But when you're talking 20 or 10 or 20-year investments, it is a lot.
It certainly is. And it was a very steep rise in the context of history and how far it's come from. So, you must remember that the US 10-year is widely considered as the risk-free rate, the rate which all asset classes are valued. So if you look at equities, you use the risk-free rate as your discount rate of valuing shares, and how do you value shares? You take all this future cash flows and you discount it to today's present value. So when the risk-free rate moves, it has a material impact on all asset classes, not just equities, also bonds and other asset classes. So a lot of investment professionals out there, I think, would have been going back to the drawing board and trying to work out what it means for their positions.
And the impact on oil prices, why would that have been had this knock-on effect?
Well, I think, oil is so interconnected with the economy. You could argue maybe less so than 5 or 10 years ago with the move to cleaner energy, but, that still doesn't mean that it's not materially an influential factor. And there's two reasons why it's such an important factor. Firstly, it's an inflationary effect. What you'll find likely is increasing global petrol prices, transportation costs, and that has not only inflationary pressures but also impacts the consumer. So there will be a knock-on consequence for consumer spending, and that's not good for companies that are chasing in a tough environment every man's leftovers, dollars and rands.
And the news coming out of the Federal Reserve from Jay Powell seemed to give the market a bit of a jolt as well.
Correct. It was a very hawkish statement, and many people were starting to think that, and including myself, and I think on this show, I said, "Are we near the top of interest rate cycle?" I think we still are, but I think it's going to take, after what he said, it's going to take longer for it to start coming down. So, rising interest rates is not a good backdrop for a global economy and also for asset classes.
I guess if you have a look back through history, when interest rates start falling is when you should be really filling up on shares, because equities do well in falling interest rate cycles. Of course, the opposite also occurs. And the consequence of this was very interesting for the year as a whole. I like the way that you've contrasted what's gone on in China, down 4.4%, with what's happened in the United States, exponential companies or FANGs, which are up by more than 60%.
Correct. And the graph that you're showing, and we labeled it Chinese dragon falls and US tech soars. So the Chinese dragon, there's a ETF out there that is called the Golden Dragon China Index, which tracks large Chinese shares and also some mid caps, also quite IT focused, probably a bit more diversified than the FANG. But that is negative -4, and then you look at the FANG, the big FANG plus index, the Magnificent Seven, so to speak, up 63% year to date. So without that exposure, and thankfully for a lot of investors, it is quite a large part of most indexes and people's savings. It's been a very tough environment. Emerging markets have been under pressure. Broad equity markets have been under pressure. In fact, the Russell 2000, which is a more broader mid and small cap representation of the market, is actually negative for the month, despite the S&P being significantly positive, largely due to those 7 shares.
These difficult times that we're seeing with high interest rates, is that a little bit like COVID, perhaps, which accelerated the already established trends? When we have a look at what happened in the online world, for instance, webinars suddenly came to the fore and so on. There were lots of consequences. Is this perhaps something similar that's going on in investment markets? It's tough times, so people are getting more focused on what they can see are going to be the winners of the future?
I think what at Corion concerns us is when you have interest rates going so quickly, so fast, escalating, is that it invariably leads to a surprise. When a company is potentially highly leveraged, having a much higher cost base, or the consumer's under pressure, when you have interest rates rising so quickly, the probability of there being a surprise coming from left field or some kind of danger is escalated. And I think what this environment highlights to us is maybe be a little bit more cautious going forward, knowing that you don't know exactly where the surprise comes from. I mean, if you go back to March earlier this year, you saw the 3 regional banks in the US under pressure and really folding because of sharp increase in interest rates. Now you're having it again. What's next to fall? We don't really know, but it's potentially not the time to take on too much risk.
Okay. Moving on to our fantasy fund manager competition. Interesting to see that Grant Morris is topping the league, and this is 5 months in. We've only got a month to go, and with only 14%. That's got to tell you, out of the thousands of people who are playing this game, the best of them has only got 14%. That tells you what a tough market the South African market's been over the past few months.
Correct. And the broad index is down in this game. The equally weighted 60 shares is down about 3.5%. So hats off to Grant. And it's nice that Grant is actually leading. He is a senior portfolio manager at Clucas Gray, manages some of Corion's clients' assets. So it's nice to know that people who we have entrusted our clients' assets with is, implementing similar views in his fantasy portfolio as he's doing for our clients and doing really, really well.
So what I also did, I'm lying about 700 of the 4,500 participants. So that's not bad. But I had a look at my portfolio head to head with Grant's because, of course, you have a look at the best in the world in class. And I thought that the appointment of Sean Summers at Pick and Pay was going to see that share skyrocketing. Of course, went down 15%. Come on, David. I mean, these moves, how does one work it out the way that the market's going to interpret news events?
Funny, because I'm also coming about 700, so I think I'm going to have a little competition with you head to head here. I think it's going to be a close finish between the two of us. And I've also got Pick and Pay hoping for a bounce. So I've had a horrible week as well. To answer your question directly, Pick and Pay, in addition to the announcement that Sean's coming back, also signaled worse than expected results. And I think that overshadowed his appointment. I thought it had more to do with, the trading rhetoric around what to expect for the future. So hence, yesterday, I think the share fell by 12%, and not doing our fantasy performance any good.
No, it isn't, is it? But, let's hope for the bounce. We're literally coming to the end of this. We're in the final straight now. From your perspective, the whole fantasy fund manager, have you been happy with it being given that it was our first, and I say our because we've also been intimately involved as well, our first crack at this?
I think it's been amazing. It's 4,500 people in your first year playing. I think we've had great partners behind us. We've had a lot of discussions with business, and thankfully you saw and your business saw the need for educating people, and the backdrop of the fantasy fund manager has a lot of educational elements to it. And, it's very rare that I don't go into a meeting where I have someone talking about the fantasy fund manager and what a good idea it was and the internal competition. So, we're very happy with the result. I think we'll potentially take it to the next level next year, but a great start. And I think, also what really was pleasing was how stable the system is. There's always a risk developing something that is a bit different, and where there's a lot of moving parts, but the interface has been well received, and there's been actually no technology glitches on the system, which was probably the one thing that maybe kept me up at night.
It's also interesting having a look at the way the Super Brew guys work on the sports fantasy games. And I'm sure there's a heck of a lot of improvement that we can bring in from the content side as well. Let's, as we always do, have a look at the individual performances over the past year on general equity. Interesting to see that the Signia funds are still up there quite well. But generally speaking, it's more of the boutiques that appear, certainly over the 1 year category, to be outperforming the bigger companies. Is this to be expected?
I think to some extent it is to be expected. I mean, we have some very good large houses in South Africa, but in an environment where it hasn't been a one-way bet, where large caps haven't been significantly outperforming other segments of the market, managers that can have more flexibility, less assets under management, move their portfolios a bit more, and invest in shares that if you're a bigger house, you probably couldn't get a big holding on, I think is a competitive advantage in South Africa. And South Africa asset management industry has been dominated by the bigger houses. It's nice to see the performance of boutiques doing so well. I think it leads to a healthier, more competitive asset management industry.
Fairtree keeps popping up. Who are these guys?
Fairtree is probably the most successful asset management firm over the last 10 years. If I look from where they are now in terms of assets under management to where they were 10 years ago. It's a collection of different investment professionals that have come together under one brand or banner. So, Fairtree provide a home for compliance, for operations, etc., and a broad investment research house. But they have run very different silos, and a lot of those silos have actually been very successful. The majority of their assets under management is actually in the equity fund, which has grown to a significant fund. So you can see I think it's the fourth largest fund in the category with assets of 20 billion rands. And they performed really well. So over a 10-year period, they really got, I think, predominantly the timing of the sector calls right, going from financials into resources and vice versa. And that has led to, competitive performance, which ultimately leads into assets under management.
Well done to Fairtree for that idea in the first place. And I suppose it's a boutique of boutiques, if you put it that way.
Correct. But as things develop, when you're managing, I'm not quite sure what the number is, but I think it's probably about 80 billion rands of assets under management. The boutique of yesterday might not be the boutique of today or tomorrow. So, what we're trying to do at Corion is actually try and look also for not only the good managers now, but who are going to be the next Fairtrees in the next 5 years and 10 years, as was the case with the likes of Investec, then Coronation, and previously Allan Gray.
And PSG, which is still performing incredibly well. On the high equity side, there really is a dominance on the best performing funds with the boutiques that are coming through here. I suppose that speaks to what you said a moment ago.
Correct. It's not surprising if you look at the list of the winners there or the best performing funds. Those are the funds that generally have been exposed to those magnificent seven, those big heavyweight shares in the Nasdaq and S&P. If you weren't there and you weren't, if you were more defensively positioned, you would have struggled.
It is interesting to see. Best performer, 36% return over the past year. Average for the sector, 13%. Worst performer, 4%. So even if your financial manager or your financial advisor has put you into the very worst fund in a high equity side, you would still be in front, which is not such a bad thing. David, we always close off with the inflows and the outflows. Now, this is a month behind, not surprisingly. I know you guys pride yourselves on getting the figures out very quickly, and you can do that when it's commoditized data. But this information, is it more difficult to get your hands on?
Correct. It's just the way the industry reports. So the performance numbers are reported daily. The actual flow numbers is always a month in arrears. So, you can only reflect the data that is present. So there's always a 1 month lag with this data. I'm not quite sure what the reason is. Maybe the industry is, just finds that a bit proprietary and don't release it straight away. But, the data comes second business day every month to what is available. Unfortunately, inflows isn't available at time of reporting.
So by far the biggest inflows in the past year went to Mng SA Equity Fund. Tell us a bit about this one.
So what Mng do, it's very hard for me to speak on their behalf, but what I suspect is they are obviously part of the global franchise, and when they have asset allocation decisions internationally and they want to invest in equities, they'll invest in the SA equity bucket. And they'll do it through predominantly this vehicle. So the fact that they have gained a lot of assets, I suspect, hasn't got to do with retail investors. I think it's got to do with asset allocation decisions and institutional decisions, which is starting to increase their weighting to South Africa. So, probably hasn't worked of late, certainly last 3 or 4 months. But it's nice to see that they, look at the one month number. That's a significant inflow. I suspect they're actually gearing themselves up for a South African rebound.
4 billion rand invested there. Who's Mng?
Mng is a big global insurance company. So previously it was a Prudential. So you would have seen the adverts hopefully around in terms of sporting events. Prudential was a big asset manager in South Africa. It was then rebranded, to my knowledge, Prudential Mng, because Mng bought a stake in that business. And then I think about a year ago, they took a controlling stake. They went over the 50% hurdle and they just dropped the Prudential name. So for your listeners out there, the old Prudential brand, it has been rebranded Mng, and that's the fund that you're seeing, the equity only fund.
I hope I'm not going to trick you with this one, but the Fussell CI Growth Fund, that's a completely new name to me. And yet on high equity, 2 billion Rand inflow in the past month and 2 billion for the year to date makes it the biggest inflow, even bigger than Discovery and Alan Gray. What gives there?
To be honest, I'm not quite sure. It's a new name to me as well. The clues that I'm looking for is it's a CR fund. So the Manco is CR, and generally CI is a collection of financial advisors' portfolios. So what could potentially have happened is this is a financial advisor who's taken his clients' assets, structured a collective investment scheme, and put all his assets into the portfolio. But that is just a hunch, maybe a strong hunch. But honestly, I don't know all the facts there.
One of the financial advisor names that pops up is Bob Fussell. So it sounds like you're on the money there. Let's close off with outflows, David.
Yeah, I think it's not surprising that the bigger outflows are from the bigger asset managers. When you have a South African industry saving industry that's been a bit under pressure, where there's been a lot of assets that have moved from South African domicile to offshore domicile, that money generally comes from the bigger houses. So you'll see the larger outflows being from those houses. So not too surprising. But I think maybe there is a bit of an element now that financial advisors and retail investors are starting to get a little bit more comfortable with boutique investment houses. So hopefully that's also an influence, and as I said earlier, good for the industry.
We keep seeing Old Mutual Investors Fund, the once dominant unit trust in the country. In fact, Old Mutual itself was once dominant in the financial services space, keeping declining, continuing to fall. Is this just a reflection of Old Mutual as a whole losing its former glory?
Look, I don't think Old Mutual will ever dominate the asset management industry as it did in the 80s and the early 90s, and it was really Old Mutual and Sanlam. I think those times have definitely changed, and that's been good for the industry because those powerful houses seeded the talent of the likes of Alan Gray, Coronation, Investec, and that was the breeding ground of the asset management industry. But I do think that Old Mutual as a house has also changed its business model. It's bought into some boutiques a while ago. So managing a lot of life assets and company assets under management. They've rather gone in terms of silos and backed other investment houses to partner with. So I think it's not just the fact that Old Mutual is losing assets. I think they're just trying to diversify the assets and also back other jockeys.
Fascinating insights on not just the markets themselves, but the whole financial services or savings industry from David Bacher, who's with Corion, and I'm Alec Hogg from biznews.com.